Hi, everyone, and welcome to our 2025 Outlook and maybe a little bit of a look backwards at the year just finished. I'm joined again by our professor, Kristian. Welcome to the call today.
Thanks for having me, Darren. Always
I'm
happy to
working
do
on
this.
getting you a nickname. I'm working on it. I don't, professor. Let's see if that one works. Clients, let me know in an email or something if you have a good nickname for Kristian. We got to come up with one. So, um, just in fun and in love. So, okay, so let's get moving on our 2025 outlook. Kristian, you've done a really good job. We put a bunch of charts and graphs together. We're going to spend about half an hour kind of going over some of the highlights from last year, lessons learned, and try to figure out where we think the puck might be going in 2025, recognizing that there's a little bit of chaos out there. So please begin.
Alrighty. Well, first we got a word from our trusty lawyers, and moving along, we had another really strong year for equity market returns. So we had another 20 plus year in the S&P 500. We can see it was predominantly driven actually by multiple expansions. So yes, the market has gotten a little more expensive. And it's not just the top 10 stocks that have driven a lot of this multiple base expansion. The remaining 490 stocks have also gotten a little bit more expensive. If we look at the chart on the right. So yes, the market's gotten a little more expensive, and really that just reflects added optimism in the market for futures earnings growth. And it is an area we're going to touch on a little bit further to see if that expensiveness in the market is warranted. And Darren and I have touched on this a few times, but it's not just the overall market that looks a little expensive. It's also been driven by just a few names predominantly. This past year, over 50% of the returns were once again driven by the Mag 7. And we can see on the chart on the far left here that without the Mag 7, the S&P 500 returned only 10%. That's a price return basis. And with them, it returned over 23%, 25% if we include dividends. And so the weight of those top 10 stocks and the weight of the Mag 7 continued to trounce higher. And now the top 10 stocks in the S&P 500 represent almost close to 39% of the overall index. But what does give us some hope in terms of an overall broadening is that the relative earnings performance in the coming year seems to be moderating. So the rest of the S&P 500, it looks like they may be able to pick up their earnings pace. And so from that perspective, we do have some confidence in a broadening. We've seen a good start to the year so far in 2025. We did see some broadening out up until the election, and then the market re-narrowed a bit. But this is certainly a theme that we're going to continue to watch very closely as the year moves on, and it certainly gives us some confidence that we're going to see some performance from other names in the index.
Yeah, and I think it's important to note that it's interesting how that concentration of performance in just those few businesses just has continued to persist. And we can see from that chart on the bottom right that almost 40% of the movement of the S&P 500, which is supposed to, well, it's a measurement of the 500 largest businesses in the US, except it's being driven, 40% of its movement is driven by just 10 companies. So and that's a problem for prudent, disciplined investors that want to manage risk, because you should have just, taken off your seatbelt and shoved your head out the window and went yeehaw, and gone down the highway last year and just bought nothing but those top 10. But we know historically that whenever that's been the case, it's worked out badly to chase returns. But so we're going to keep an eye on this. We recognize that this is going to continue to be a driving force. But as you said, Kristian, we're hoping that this widens out a little bit. And I'm very reluctant to, as I say, throw risk management out the window, undo our seatbelts, and just dive into those top 10 and hope that this trend continues, because we watched this, and I've reminded everybody about this for years. We saw a very graphic display of why you don't do that back in 1999 and 2000 in Canada, when Nortel and JDS Uniphase became more than 50% of our stock market's movement. And everybody that piled into those thinking, hey, the party's never going to stop. Wow, did that ever end badly? So maybe that's just an emotional disturbance I have, but you do have to listen to the lessons of history. So we're going to keep an eye on this. We're exposed to these themes in a lot of ways, but we're not going to throw everything out and just focus on these. So just to make that point really clear. So thanks, Kristian.
Yeah, exactly that. And we have a few charts coming up a little later in our presentation on still why we believe in the benefits of diversification. But as Darren mentioned, we still are exposed to these entities, and we're just very carefully monitoring that if they can continue to meet these very lofty expectations that become embedded in their stock price. So we talked a little bit about the US. Again, we just said a very, very strong year. Well, what about outside of the US? Well, really, outside of the US, since the great financial crisis, markets have really kind of meandered along, and the US has been the predominant driver of global equity returns. In conjunction with this, the US equity market now represents over 67% of the global market capitalization. And if we look here on the chart on the left, there was a pretty wide dispersion in 2024, as well as in the last 15 years, the US relative to the rest of the world. Canada actually held up pretty well last year, returned 23% on the S&P TSX, 21% on the S&P TSX 60, which is our 60 largest companies in Canada. So it did hold in. Taiwan, if you can see here, is actually one of the notable outperformers. But really, that's because over 50% of their index is constituted by Taiwan Semiconductor, which had a phenomenal year. So the US is still certainly the best name on the street, but it is looking expensive. And we're going to get to that a little bit later on in our presentation.
The other back, if you go back one more there, Kristian,
Yeah.
one thing that really jumps out is around currency. I think that's an important element to look at. So, like if you Canada's highlighted there. So if we look at the Canadian local market return was over 20%, but in US dollars it was 12 and a half. So, the Canadian dollar, as we'll see in a minute, versus the US has also been a really interesting story this year. So I'll just plant the seed for that one.
Yeah, and one thing we also wanted to touch on, and we did warrant against this in the summer, where we said that the ultra low levels of volatility that we saw at that time is not something we think we're going to persist. And certainly since that point, we've actually seen more elevated levels of volatility. Interest rate volatility returned once again following the December FOMC meeting. We had the yen carry trade unwinding earlier this year, and of course, we had quite a bit of an election uncertainty and volatility leading up to November. And so we actually think that volatility has the potential to persist into 2025. And this is really due to a confluence of factors impacting markets, ranging from Trump, which we will get to, rest assured, monetary policy and inflation fears, and still some remaining geopolitical conflicts. And if we look towards history, volatility is not something that's actually uncommon. On the chart on the right here, we can see that, in many instances, there are double-digit declines in the S&P 500 in several years, and still the S&P 500 ends up finishing positive. So volatility is very much something that we expect to remain present in the coming year, but it's not something that we think you should be afraid of.
Yeah, and I think if we learned anything from Mr. Trump is that prepare for the unexpected, expect that. So I think we're going to see some bumpiness. I will say again, you said we weren't going to avoid Mr. Trump. I will say one interesting thing that it really demonstrates a difference to this how he came into power this time versus last time. And this isn't a comment on whether it's good or bad. It's just an interesting distinction. Is that I think it's fair to say that when he came into power the first time, there was chaos. Like he didn't seem organized. His team didn't seem organized. The press was all over him, very distracting. And I partially it may be because he may not have thought he was going to win. So they didn't really seem to have a game plan for the first while. You could argue maybe they didn't have a game plan for a while, but I would say that the first couple of weeks of his first presidency were just bonkers. This one, again, doesn't matter whether you agree or disagree. The fact is that on day one, he signed what 125 executive orders. He just sat there and did them with the press, and very targeted, very specific, very on target to what he said he was going to do. This is a remarkable difference from the last time to me. So maybe we are going to get a bit more of I'm going to do what I said I was going to do. Which again, whether you like it or not, I just look at it and say, if we can just have a playbook that we can actually trust is going to happen, that's helpful. But we'll wait and see. And historically, he said a lot of things, and many of them didn't happen, but some did. So I think we just buckle up this year, and the first year of his presidency could have lots of movement to it. So I think we're just going to be prepared for anything. I feel like a goalie, and I got guys with 5 pucks coming at me. We're just going to figure this out. So going to be tricky. But you're right. That graph historically has been that even in a year that we had volatility, years can finish positive. So we're not going to get deked out.
Yep, and we'll get to Mr. Trump's game plan in just a second. And so we've just kind of recapped 2024 rather quickly. And if you haven't had a chance yet, we would recommend looking at our quarterly outlooks as well that kind of went through the year as well. But again, very good year on for most risk assets, and especially for U.S. equities. And so what are we looking at for 2025? Well, I've titled this "Herding the Sheep," and maybe that's a little harsh to Wall Street strategists,
It's
but
fairly accurate, though.
it is fairly accurate in this instance, just because we see such a concentration here around the median, which is a 13% projected return this year for the S&P 500. So 90% of strategists this year are plus or minus 2% of that 13% average. A year ago, the average Wall Street strategist was projecting a 1% return for the S&P 500.
Boy, were
Fair to
they
say,
wrong.
we did a little bit better than that. So broadly, sentiment on their end is very, very positive. Double-digit returns again this year, and certainly that's something we are happy to welcome. But bullish sentiment is not just in terms of strategists. Traders, advisors, even the average consumer, they're all expecting much higher stock prices again this year. So broadly, sentiment across the board is very positive going into 2025.
So,
And
which means Murphy's law says it probably won't happen the way we think or they think.
well, exactly that. So, as a lover of history, and so too apparently is Larry Adam, our group CIO. And if you saw his webinar last week, he may have stole my thunder here just a little bit. But General George Patton, famously one of the commanders of the U.S. Allied troops in World War II, has said that if everyone is thinking alike, then somebody isn't thinking. And so, who's not thinking? And how are we thinking, and possibly differently? So, on that end, let's take a look at the US economy. And so, we're going to start with US inflation trends. US inflation trends have come down, but they've leveled off a bit above the 2% target range. And certainly, when we spoke at this time last year, we said that inflation had the propensity to remain a little more sticky than what the market was forecasting. But it has come down quite considerably. And inflation around 2, above 2%, around 3% is not actually a bad thing for markets. And inflation expectations have actually remained really well grounded if we look at the chart on the right. And that's something really that we want to remain cognizant of, because as long as those remain well grounded, it usually bodes well for overall markets to perform. And so when we look at the decomposition of the inflation basket, we can see here that, yes, it's come down, and there is actually some disinflationary pressure still to come from shelter. If we look on the chart on the far right from more advanced statistics, such as the new tenant rent index. And so right now, we're not actually seeing really a cause for alarm for a significant reacceleration in inflation. Yes, it's leveled out above target, and yes, it may stay above target, but really we're not seeing at this point in time factors that would cause it to reaccelerate as high as we've seen in 2022, which are some of the headlines you may have seen recently in market news sources. So right now, the inflation picture looks okay. Yes, it can remain sticky, and that's going to feed into Federal Reserve decision making. And on that point, interest rate expectations have really come up over the last year. And this is another area that Darren and I both spoke to last year as towards our long run outlook. We said that we really, the era of 0% inflation interest rates is no more. And we expected interest rates to actually remain more elevated than what the market was pricing. So if we look at the bright blue dots on this chart, that's where the market was pricing last year for this year. And we've settled about 75 basis points higher for the end of 2024 and almost 100 basis points, so 1% higher for 2025. And from that perspective, really what we are seeing is that the market has come around to the opinion that yes, interest rates are going to remain a little structurally higher than what they initially thought. Right now, they're pricing in about one cut for 2025. And even FOMC members are saying, our long run projection was 2.5% for next year. Now we're saying our long run projection is 3%. So they've revised their updates up to 3%. So broadly, interest rates have come up and the expectations for interest rates have come up. And we expect the Federal Reserve to remain on pause until we get some greater clarity on the economic picture. And some of that certainly is going to be influenced by the first few months of President Trump's presidency. So this adds an added layer of uncertainty into the markets, and corresponding with this higher view in federal fund rates, we've actually seen a pretty significant sell-off in long-dated bonds since since Trump's presidency and election in November of 2024. So that's predominantly been driven by a rise in U.S. term premium. So just as a refresher, term premium is the additional compensation that an investor obtains for holding long-term bonds versus short-term bonds. Earlier this year, it was very, very low and certainly low to historical standards. And that's something that we were very cognizant of. And now, with an unclear picture really around government policy, a rising fiscal deficit that will need to be tamed, and certainly results in continued issuance in government bonds, it's meant that investors are coming around the view that, you know what, we want to be greater compensated for this level of uncertainty. So that's the interest rate picture, and certainly we just talked on the inflation picture. And so now we're going to move into our view on the economy. And our view on the economy is really driven by our view on consumption. So consumption drives 70% of GDP. And so how do we break down what drives consumption? Well, ostensibly, what we like to look at are three areas. One is labor, so that's the ability to earn income and then spend that income. The other is savings, so that's your ability to draw on your savings to spend. And the last one is the use of leverage, so your ability to borrow to fuel spending. And so when we look at the labor market, certainly it's in better balance than it was at this point last year. We see openings have come down considerably, quits rates and hires have come down considerably. Layoffs have ticked up, but certainly, we remain at a level that is well below the historical average. So the labor market's in better balance, and that's one area that we really want to continue to watch closely. It's not showing any red flashing signs of warning yet, but since we're in a different place now than we were a year ago, we just want to make sure that this doesn't deteriorate any further. And so when we look at the next picture of our consumption, it is savings. So savings in three charts here, and we're going to start on the far left. Personal savings rate, that's about 4.8%, below the historical average, and it was revised up earlier this year from a very low level. But certainly where it's at now doesn't really show us that the average consumer is going to be able to draw or have much room to draw on their personal savings to fuel consumption. And then moving to the middle chart here, a lot of what headline news has made is that we have trillions of dollars in money market funds, and that's going to fuel consumption for years to come. We would caution on that statement just because the majority of these funds are held by the wealthiest individuals. And those individuals are really unlikely to change their consumption patterns depending on the economic environment because they have that draw of excess wealth. And really, the bottom quintile of households have very little of these deposits in money market funds. So we would caution about making that statement that money market funds are going to be the savior towards consumption if other areas of the consumption picture run out. And the last picture of our savings chart here is really that excess savings have been depleted. So, like a ghost in the night, they vanish pretty quickly. Excess savings have all dried up, and we've gone below what most measures were. So that's really what's helped the market, especially in 23 and through parts of 2024. And so we really don't have that windfall at our back now. So when we look in aggregate at the savings picture, we don't really see a significant ability for this to drive future consumption. And so our last
Well,
prong here,
before I go on, because
yeah,
this is going to tie into the borrowing. What's also been interesting, and we talked about this a few years ago when that savings rate was really high, and COVID, people had money in their bank accounts because you couldn't really go anywhere or spend anything. And if you did want to buy something, it was probably out of stock. So savings had built up. And one of the negatives to that was in the earnings of the large US banks. Because if people aren't borrowing money to buy stuff, then the banks, that's where they make a huge amount of their profit. They need us to be in debt. And so what's been interesting to me is we kind of called that out back when savings rates were high, that banks were having this big hole in their balance sheets because people weren't borrowing. Well, guess what? We've now seen bank earnings recover in the United States pretty dramatically as people now are turning back to needing their credit cards, needing their car loans, needing their mortgages. So it's not always bad news. It all sometimes depends on where you stand and what your perspective is. So as I say, our US banks have actually done really well, primarily because consumers maybe aren't. So
yeah,
that's the way it goes sometimes.
yeah. And looking at that borrowing picture, to your point, Darren, we saw credit growth really rise quite considerably up till 2022, and then it's been on a downtrend. So why is it coming down a little bit? Well, interest rates, so the cost of borrowing, have become quite onerous for the average person. And we're starting to see that feed through in terms of credit card and auto loan delinquency, which have begun to tick up. And so, given where we are with a higher structural interest rate environment, we certainly think that the average person's ability to borrow at these levels is a bit constrained. So, in aggregate, we just looked at all three pictures. Yes, there's been US economic exceptionalism. Yes, that's been driven by a very resilient consumer. But the conditions are different now than they were last year. And so, we're going to think that we're going to monitor this more closely as the year develops. And certainly, the labor picture we think is going to be a significant driver of the year ahead. The
Yeah, and
other
remember,
thing,
and
yeah,
sorry, but just
sure,
to
go ahead.
point out that, by the way, this is all by design, right? Like the reason they raise interest rates is to slow the economy, and that means it's more expensive to borrow money and buy things. So this, we saw interest rates went very, very low in COVID. They want to get the money out there to restart the economy. That does, and I called this out on some of my walking with Charlie's and things, that was going to trigger inflation. That's exactly what happened. And then they raise interest rates, and in 2022 they raised them dramatically to just hit the brakes on the car. And now we're seeing again the output of that the car loan delinquencies, credit card, those are all going up because things got more expensive. So all of this is by design. So if you want to get mad at anybody about this, get mad at central bankers.
Yeah. And so, we talked about the consumption picture, and maybe what are some risks to this view? Certainly, one of them is policy impacting economic growth, and a name so nice that the American majority voted it twice. Trump 2.0. So Trump 1.0, we saw initially when he was voted in a significant rise in small caps, banks, and then in the immediate aftermath, really those two areas had struggled to regain their footing and reach the new highs. And so Trump 2.0, what we've seen again is a really significant rise in small caps initially, very significant rise in financials, and then rise in the 10-year, which we'll get to in a little bit. So we've had the same playbook play out in the first few months here. And what we really want to caution against is making widespread assumptions about how the next 4 years are going to look and what areas of the market are going to perform best based on what happened in Trump 1.0, because the initial few months don't often look like the next 40 plus months. And the other area we also would like to mention is that, by conventional wisdom, Trump 1.0, the market expected energy was going to be the best performing sector. It was actually the worst performing sector. Technology was the best. But under Joe Biden, energy was the best performing sector over his 4 year tenure. So things don't often
Which is
happen.
amazing when you think back to the Green New Deal and other things. You would have thought the opposite. It's wild.
Exactly that. And so now Trump is actually entering at a very different time than he did his first go around. Interest rates are starting at a much higher level. Inflation, as we mentioned, is certainly higher than it was in 2016. And while we continue to favor long term drivers of markets, specifically economic growth and fundamentals, what can we glean from his policy announcements to date? Well, one thing that he has made clear is that he wants to reconstitute US trade balances. And the way to achieve this, at least in his eyes and the eyes of his administration, is functionally through tariffs. Now, these could be used as a bargaining chip, and we know Trump is a lover of the art of the deal. So, duration and magnitude to be determined. But what has been proposed is certainly more than what even occurred in his first term. If we look on the chart on the left here, that shaded line on the right, it's almost at its highest historical level. You have to go back to the early 30s for tariffs proposed at this level. So, in conjunction with this, international trade uncertainty has risen. That's led to a rise in inventories in advance of possible tariffs. And as we're seeing it impact business investment a little bit, just because leaders are uncertain as to what environment they're going to be operating in. But, and this is a big but, we want to make it clear that the transmission function for tariffs is actually not very linear. And so we're just going to need to go through a little thought exercise here. So just bear with me just one moment. Um, if we look at tariffs, and we're going to look at it through a US lens first, don't worry, we are going to get to Canada because I know that's on everyone's mind. But from the US perspective, if they implement tariffs on the rest of the world, yes, that's going to lead to higher import prices initially because you're going to be raising the price of goods that come into the US. And this is going to get passed down through to the consumer, and inflation could initially tick up, and that could deter consumer spending. But if the US has a stronger US dollar, and that's something that certainly they're banking on, especially with interest rate differentials remaining quite strong, that could mute some of the impact of tariffs because now those cost of goods are essentially offset. But in the process, US exports could be depressed because that means it's more expensive for the rest of the world to purchase US goods because they're priced in US dollars. And if retaliatory measures are made and foreign goods become more expensive, it's possible that production then turns inward and the US consumer begins to spend internally, and maybe that helps output. So that's just a really way of just kind of going through a big puzzle here to tell you that tariffs don't actually function as straightforward as what the market might tell you. This is something that we're going to have to wait to play out. And as I mentioned, we really don't know the duration, the magnitude, and the effect of these tariffs as they're going to be implemented over time. And we would caution at taking Trump at his word or literal all the time, because it does seem like he can change his opinion quite quickly. So don't believe everything you read on the financial headlines.
No, and I'd also offer that Trump is not using tariffs as policy; he's using them as a stick. And I think that should be clear to most people. This is entirely about bargaining. It's got nothing to do with long term trade policy, in my view. He just wants to use them as a bargaining tool. And I'm also a little surprised when I watch, other countries like Canada and our leaders. I'm watching what their reactions are to his style, and the first thing that jumps to mind is: has no one read The Art of the Deal? Like, he kind of is doing what he's told you he's going to do. He kind of comes into the room, knocks over all the furniture, feels like he's the aggrieved party, and everybody's out to get him. And he's just trying to move everybody around, knock things off balance, and he's looking for where the weaknesses are. And I'm amazed that people are falling for this. This is a very old story and strategy that he's used, and he's very effective at it, clearly. But I think the politicians, if no one listens to me, of course, but if they did, I'd say maybe don't operate in the same way back to him. That's not really going to work. I think you got to be recognizing that's the strategy and try to outthink him in some ways, and recognize that he does have a lot of power. This isn't the old, the bully in the schoolyard that you walk up and punch them in the nose and that settles them down. That is not the way to deal with someone with this degree of economic, military, and other power. So I think there are ways to deal with them that we've seen people successfully arrive at deals with them in the past. Learn from those. But I just offer that I think maybe read The Art of the Deal and you'll see his game plan a little more clearly, because he did tell everybody what he does. So moving on. So the tariffs thing, I agree. It's not great for anybody. That's why we have free trade. But I think he's using this as a stick, not as a tool.
Yeah. And to the extent maybe we look at his other policies, certainly what we see under Trump is actually a continued rise in the fiscal deficit. So what we know about Trump is he wants to continue his initial tax hikes, which are due for an extension, and possibly reduce corporate and personal taxes to help fuel some more growth. And in the initial aftermath of the 2016 and 2018 tax cuts, what's important to note there is not all of that actually ended up flowing into the economy. A lot of corporations actually held on to that extra money and ended up using for buybacks, for instance. So we're going to see how those affect the economy to the extent that he initiates them. We also have countervailing forces in the form of possibly decreased immigration, which can rise labor costs in areas such as farming and construction. And we also may have a more accommodative regulatory environment. So we have a lot of forces that currently are acting in conflict with one another based on what his policy announcements are. But what we do know and what we do project is that the deficit is going to continue to rise. And to that extent, we think the bond market will keep Trump in check if some of his policies get too egregious from a spending perspective.
But I think his mantra is going to be growth solves all your problems. So keep spending.
And so that brings us, we just talked about the US and Trump. Certainly, we're going to wait to see how that policy plays out and really see what the economic implications of that policy are when it's enacted, and not just what's said. And the other thing that we're going to keep in mind here is the 51st state. Now, we think that comment is made in jest, just for the record. And I'm not sure if he really wants to take over us. I think I had a minus 30-degree walk into the office this morning. I don't know if Trump wants to bear that. I think he took his inauguration in house, so we'll see if he wants to bear the cold. But
Well, and now
nevertheless,
it's snowing in Florida, so maybe he's getting it like, whoa, maybe I don't want the Great White North to come down here so much. Maybe not. Maybe that's our little way to have some revenge on that statement. But I think just on your point, I think it was a joke and it just stuck. And I think Trump, in some ways, he's a burlesque performer. So hey, if that joke worked, let's double down and keep doing it. But again, I made the comment earlier that he's very good at moving things around and finding out where people's buttons are and giving you nicknames and everything else. And he's really good at that. He's like that kid in high school that, man, that was annoying that he gave me that nickname, but it's kind of mine for life now. That's why I'm trying to give you a nickname. But let's talk about Canada, because I think we're in a very different place in a lot of ways than where the U.S. is, and unemployment being the place to start, and outlook being not great.
Yeah. So when we look at Canada, our unemployment rate's risen about 2% from its lows. And so by some measures, we may have actually been in a technical recession. Business outlook and hiring intentions, as they correlate to private employment, have remained pretty depressed. So the overall labor picture in Canada has been weak and weak for many months now. The inflation picture, though, I mean, on the back of wage inflation coming down because of a weaker labor market, as well as other areas of the inflation picture coming down, especially as interest rates have come down, the inflation picture is coming to much better balance. It's certainly within the Bank of Canada's target range. But this is also correlated again to the chart on the right here, just to add on to our point. The average business barometer and real GDP have remained really quite low. So the Canadian economy has really trundled along here the last year, especially relative to the U.S. It's done much poorer, and so the overall picture for the Canadian economy still remains somewhat weak. There were some recent data points that indicate maybe it's starting to pick up, especially as interest rates maybe help the average consumer, which is much more levered than in the U.S. But there are some very significant tail risks to the Canadian economy. And one of them certainly is a possibility of a trade war. So,
Oh,
uh,
before you go on to the trade war, if you can go back
yeah,
one, because I think this is going to matter as we go into. We're definitely going to get election in Canada. I don't know if it's going to be in the spring or the summer or the fall. No one seems to know, but we kind of need one given that we don't really have any leadership right now. But I want to make this point about inflation because there's going to be a lot of talk by politicians about how inflation is moderating. It's not as bad as it was before. And when we look at charts like this that show the rate of inflation over time, I think it kind of gives the wrong message because it doesn't really align to what all of us are feeling when we go to the store. Is that it looks like it's moderating, but remember, it's been going up. And so it's not like prices went back down again. They're just going up less fast.
mhm,
So all of those previous high inflation numbers, the price of groceries, price of gas, price of everything, are baked in the cake now. So when we look at that graph and say, oh, inflation's coming back down, well, it just means the rate of growth is slowing. The rate of things getting more expensive, they're just getting expensive more slowly, but they're still way more expensive. Nobody's gone back and fixed the problem and put the price of milk, price of gas, price of eggs back to where it was 5 years ago. That's not what happens. So I just want to make sure people are really mindful of that's why high inflation is really a problem because it just permanently makes everything more expensive. So just keep that in mind when you hear politicians claiming victory over inflation. You didn't really slay the dragon, guys. So
yeah.
anyway, let's move on. Thank you.
Yeah, and no problem. And so when we speak about some significant risks to the Canadian economy, the Bank of Canada did this exercise a few years ago where they simulated the results of a potential trade war and a 25% tariff, which is what Trump has indicated, at least on the surface. I know he said now February 1st. There was indications before that they're going to wait and see. So I wouldn't take February 1st as a hard and fast date. But nevertheless, a 25% tariff on the Canadian economy would be very detrimental. But what can we consider about the possibility of U.S. tariffs on Canada? Well, outside oil and gas, the U.S. actually enjoys a pretty significant trade surplus with Canada. And when we consider our exports of Canadian heavy crude, the U.S. actually uses this ostensibly for the refiners out west. And we have very close proximity to those based on our oil production in Alberta. And so the U.S. enjoys our cheaper oil, just for the record. And they import 40% of their overall oil production, and 52% of that comes from Canada. So, if higher oil prices are the result of Trump's tariff policy against Canada, we doubt that they last very long, given that Trump has publicly stated, as recently as his inauguration, that he wants to bring down oil prices domestically by 50%. And I think that'll be very difficult to do without Canadian oil and gas. The other thing I'd like to mention around tariffs really is that, and Darren mentioned this with respect to Trump's Art of the Deal playbook. If in the months ahead Canada can demonstrate to the U.S. that we can be a better ally when it comes to areas such as better border security, increased defense spending, and economic security, this could blunt the duration and severity of tariff. Uh, Most of Trump's recent comments have been on this respect. And so, certainly, if we can begin to address some parts of these problems, we think Trump will look on Canada more favorably.
Yep. Moving on. By the way, that chart that you showed about the degree to which our trade deficit exists or is a surplus, this is Danielle Smith's argument when she goes to Washington, and it's a very powerful one, I think. So this whole Team Canada thing we're watching, I think maybe someone should pay more attention to Danielle Smith in terms of that's actually the correct way to look at the math, and I think she's trying her best to explain to Mr. Trump, to President Trump, that by the way you're looking at Canada and everything else, at least from a tariff perspective, on in terms of our trade, maybe isn't what you think it is in the headline. Now, there's other points that he's making about our NATO commitments and managing our border and fentanyl. Those are other issues. But I think on the trade one, I think that argument that you just showed is a very good one to remind people of.
Yeah. And so, we don't want to be all negative on Canada because, there are avenues to help us tackle these problems. One of them, and it's been highly publicized, and certainly the National Bank's been a key advocate of this, and they've used their chart here on the far left, is actually to remove interprovincial trade barriers. And so it's been estimated that the cost of interprovincial trade barriers account for a tariff equivalent rate, tax rate of 21%. And if we're thinking about 25% tariffs and 21% interprovincial trade barrier, to the extent that we can help lessen this, that could severely blunt the effect of tariffs on the Canadian economy. It's been talked about for a long time, so hopefully we actually have some progress this time around when it comes to this. The other thing is really addressing the productivity gap. We talked about this last year. Productivity in Canada continues to worsen, the gap relative to the U.S., and our R&D business funding continues to stagnate. So people really aren't investing in Canadian businesses and the Canadian economy, back into the Canadian economy. And one of the reasons behind that, certainly, I think, is some political uncertainty, but also the mess that is our tax system and the possibility of a capital gain inclusion rate. And this disincentivizes business. And Darren, you've spoken to a number of high profile tax attorneys in Canada about this issue. And really, I think there's a big consensus on how detrimental this has been.
Yeah, and on that one, if people want to listen to, maybe I'll figure out how to put a link up here to the podcast episode I did on two-way traffic with Trevor Perry and Kim Moody, both of them being very prolific tax fighters in Canada. We talked extensively around what some of these tax policies are and how difficult they've been and what the damage has been to the uncertainty they created, both to Canadian taxpayers, investors, but also global investors wanting to come to Canada. So, and you can see in that chart about labor productivity and R&D funding, Canada has just not delivered anywhere even remotely close to our cousins and neighbors in the United States. So this productivity gap is significant. And unless someone really takes this seriously, it's going to continue to get worse, in my view.
And wouldn't it also be great if Canada would focus on industries it's great at, such as our natural resources? I mean, we enjoy the third largest oil reserves in the world, so it'd be great if we can unleash some of that production.
Well, and
So,
I think there's also a big opportunity for us to get not just call them old businesses, the extractive businesses, but I think there's also a massive opportunity for us to lever into the new businesses, because things like AI, we know, or crypto, are gigantic data and energy consumptive industries. They need a lot of space, they need a lot of energy, they need a lot of cooling for those things to work properly.
Mhm.
And I think when we get into the AI thing in a minute, the degree to which this stuff is going to continue to grow is unbelievable. Like we ain't seen nothing yet. And so the ability for Canada to take a leadership role in data centers, data processing is enormous, but we could miss the boat. So that's especially when our politicians are looking at other things like themselves and their own internal organizations as opposed to what's best for Canadians. So I'm trying not to get too political, but this is massively disappointing. But anyway, let's keep moving on here. We're at 35 minutes, Kristian, so we'll keep the ball rolling here. Oh, the
keep it
Canadian
rolling.
pace. So you're taking all the shots at everybody today. You just
Apparently,
can't
so
help
I
yourself.
can't take credit for this one, though. I mean, a couple financial publications have kind of
This
coined
is
this
an old
term,
joke, by the way.
and I actually quite liked it, and I think it's very relevant. So, interest rates in Canada have come down significantly, especially relative to the U.S., and that interest rate differential has driven weakness in the Canadian dollar versus the U.S. dollar, and that's something Darren and I have harped on going back at least a year now. Is that we were very much more positive on the U.S. relative to the Canadian dollar, and we do expect some more cuts in Canada, especially given an uncertain tariff environment and possible detriments to Canadian growth. And Canada is in a different position in the U.S. to cut rates. So they may cut another 25 basis points at the next meeting, especially with this tariff overhang, and then maybe take a pause. But certainly, that interest rate differential gap is not expected to narrow anytime soon. And really, that's been reflected in our currency. So right now, we've dropped below 70 cents Canadian dollar per US dollar. It's really been exacerbated since Trump's been elected, and that sell off has been quite extreme. And a lot of that has been to the tariff comments. But certainly, right now, we're not seeing any upshoots to the Canadian dollar, especially given the backdrop that we just discussed.
Now, by the way, on that front, we've been writing our portfolios to be very much US dollar centric in our portfolios. So we've not only had good performance from the underlying securities, we've also had the wind at our back when we do a conversion back to Canadian dollars. So that's actually been an extra positive for us. I'm very mindful that whenever this turns, we don't want to give that back, because there will be a point at which, fingers crossed, the Canadian dollar does find a floor and begins to go back up again. I would argue that that will not happen until domestic and global investors see a better vision of the future. And right now it's so foggy and cloudy because like no one apparently is up in the pilot's cockpit flying this thing. So I think once we get to see a little more positive direction, and again, as positive as viewed through the lens of investors, then I think you will see the Canadian dollar, as I say, find a floor and begin rising back up again. And Kristian and I are already working on some strategies to make sure that we kind of pivot our pivot. There's a very 2023, 2022 word. We pivot our currency exposures, because there are ways for us to maintain the underlying investment in the US, but hedge the Canadian currency. So we're kind of looking at how do we want to do that when we think the time is right. We're not going to get it exactly right, but I just think that as the general trend begins to turn, we want to be able to move so that we don't give that currency lift that we had all back again if the Canadian dollar rises. So I don't know if that's the story of the next decade, but it's certainly a very big factor we're looking at and trying to get prepared for. So anyway, Kristian, we'll keep this rolling
We'll keep the
along
train
here.
moving. And
Yeah, we're going to go around the world now.
thanks for everyone that stayed with us so far. We're going to do a quick trip around the world here. Starting in Europe, Europe's been basically flat to dead over the last couple of years here. GDP has been basically in contractionary territory or near zero, so they haven't been growing. And advanced indicators such as capex intentions and business climate surveys continue to indicate a very weak environment in the euro area. So Europe's not doing so great, and it doesn't look like it's improving anytime soon. China also not looking great. They'll probably need the equivalent of a fiscal bazooka to get this economy going, because people are just not spending, and they can't really incentivize spending through traditional monetary lenses because no one really wants to borrow, even though they've dropped interest rates considerably. And so the government there will really need to step in more than what they have to help incentivize spending, and we haven't really seen that to date. And on top of that, China is pretty susceptible to trade worries, especially with the US, and we saw that in the first go round with Trump. And so when we look at China in aggregate, we're really not seeing significant pickup there. And so where does that leave us? Well, we just talked about the U.S. growth outlook. I mean, if we look to relative to the rest of the world, yes, the U.S. looks expensive, but their growth outlook is certainly in a much better place. And that's been reflected in forward earnings estimates. We see that in the chart on the far left by the gray line. U.S. is going up and to the right. Everywhere else is kind of staying flat or going down. And so we think the the expensiveness of the U.S. market is warranted, and certainly we're not seeing signs yet in the rest of the world to justify going there, given where their economies are at. And so the other and last point I want to make here is on the chart on the far right. First trade war actually did pretty well for the U.S., and so that's something we're also going to keep in mind going forward. So in aggregate, yes, the U.S. market is expensive. Yes, the rest of the world is looking weak and continuing to look weak. And so the expensiveness of the US market, we think, is warranted at this point in time, and we're not seeing the indicators to the otherwise.
Now, I'm glad you put all that in. Now, by the way, everyone knows I do love a sale. So some of these places are getting cheaper. We're not ready yet to make any big wholesale moves. We do have a global component to our models, but it's been very selective. So there are, even though in aggregate we think most European markets are not in a great place, we do go cherry pick. So there's things like Novo Nordisk, for example, which is a European company, and they make Ozempic and all these other things that are helping with obesity and weight loss and managing diabetes. That's a very interesting business. And there's other examples. I won't give them out of time, but there are examples where we're kind of going in and picking businesses that may reside in Europe, but we think they have really good outcomes. So we're being very selective. There will probably become a time when we want to make a larger allocation to Europe, when it's just the value differentials, as again, if it hits a floor and begins to turn. But I've also been saying that for 10 years and we haven't done it because it just hasn't paid off to do that. It's been better to be in the United States. So, but we keep our radar on. So,
Yeah.
okay, let's keep going.
And the important thing also to mention there is that, when we speak of U.S. entities, 40% of their underlying revenue comes from outside of the U.S. anyway. So you are getting some embedded global exposure too. But certainly, as you mentioned, Darren, we're going to continue to watch that trend as it unfolds. And the other part we want to talk about here as a trend is really, we talked about multiple-based expansion, and certainly the U.S. market looking relatively expensive if we look at historical multiples. And so to that end, we think that earnings will have to be driving growth going forward. It's going to be a little more difficult because profit margins are at record highs, but we are still seeing room for opportunity across the US market. And one of the things that we want to touch on before we get to some of those areas of opportunity is that, diversification still remains really important. If we look towards last year, 25% of companies in the S&P 500 actually finished down 5% or more. And so to that end, we still believe and have conviction in the benefits of diversification over time, and still use it as a prudent risk management tool.
Yep, and back to that Magnificent Seven thing. Yeah, sometimes people think it's easy to look back and go, "Well, you should have just bought those; they were the ones to buy." Well, thank goodness you bought Nvidia, but what if you bought Peloton, right? Or I can give you a list of other companies that did not fare very well, and sometimes it's very hard to tell from. You can't really predict the future. That's like trying to tell me who's going to win the Stanley Cup in 4 years from now. Like, you just don't know. So that's why we have to diversify. You don't know who the winners were until you look backwards. So we do our best to forecast what businesses, entities, and everything else, but we don't actually know. So we do have to be hedging our bets by buying businesses and staying diversified across industries, because in investing, that's really the only free lunch. So, and I really believe investing is about being mostly right than being really wrong. So there you go. Okay, what's the next chart we've got, Kristian?
Yeah, and so for those of our fixed income geeks that may be on the call, just as to quickly touch on our views on the fixed income markets and bonds, similar to equity markets, risk assets in fixed income perform really well. So credits, overweights performed really well. So if you're in lower quality fixed income, that's done very well. But spreads are now really as tight as they've ever been. Investment grade, you're in the top 1 percentile of spreads. So that's a compensation you're getting over equivalent government securities. High yield spreads there look pretty tight. So the fixed income market's looking pretty expensive on aggregate, but we are finding some areas that are actually giving you pretty attractive yields without taking on a lot of risk. So areas such as U.S. Treasuries, agency mortgage-backed securities, and some areas of investment grade credit, you're actually not taking on a ton of credit risk, and you're getting compensated now with yields close to 5%. And we think that actually is a pretty good level to diversify portfolios if you're looking for a fixed income component. So that's our fixed income talk. And to finish off our presentation here, we talked about still finding opportunity. We talked about the necessity for earnings growth and relative earnings growth to drive forward market returns. So where are we finding that earnings growth, and where are we finding that opportunity? Well, we have three trends that we've found through our bottom-up research process that really we think are going to persist over the coming year and years to come. The first of that is AI. Obviously, it's been well coined at this point. It should be no stranger to anyone what is going on with AI here, and certainly the hunger for energy, cost of hardware, training, computational demands for AI systems. They've all grown considerably. They're projected to grow by an average rate of over 260% over the past 4 years. And by 2030, projections are that a model will use the equivalent of 6 gigawatts of power. That's the equivalent of 6 nuclear power plants. So on top of that, data centers are projected to make up over 8% of US power demand by 2030. So it's a transformational technology. We believe it is a transformational technology. And if we look towards history, there's actually a propensity for an underestimation of how well and how prevalent these technologies actually end up becoming. We've underestimated the use of PC, internet, mobile, and cloud over time. And it's very likely that if we look at AI in 20 years, we're going to do the same thing. But there
Yeah,
are
and
some,
and sorry on
yes,
that, just to interrupt for a second. I think that's a really important point that I really want to make sure people remember. All these technologies that we've gotten used to, we didn't realize how big they were. Like go back and remember when you first got a computer in your house back in, the 80s, for example. This is before you were born, Christian. You had to put the floppy disk in to make it work. And you got this thing, it cost a fortune. It took 10 minutes to load up. And you used it and you're like, okay, apart from maybe putting in my spreadsheet for a budget and playing Pong, I'm not entirely sure what else this thing does. And then it got connected to the internet. And then you're like, wow, the internet's really cool. The World Wide Web, the information superhighway. And you're like, this is really good. But it seems to be, like I would use Netscape and it was like, okay, it's a big yellow pages. Oh, I can do an email to somebody. Oh, I can write a letter. We had no idea what it could do. But at its infancy, it's like, this is interesting. I'm not sure what to do with it. I remember my first cell phone came with a car attached to it. It was in the car, and it was a mobile phone. It didn't do anything else. It was just I can phone somebody and get a crummy connection that would drop and was really expensive. But now, like the phone is everything, and things like iCloud, like our ability. I remember when I first talked to a technology manager years ago who said, "Darren, the next big trend is going to be machine to machine communication." And I said, what are you talking about? And he said, they're putting these little transmitter receivers in all the devices that are out there, not just your phone in your car, but your dishwasher, your television, your refrigerator. They're all having these little Bluetooth transmit. I'm like, what is Bluetooth? What are you talking about? And he said, it's going to be like Star Trek. Like your phone is going to connect to your car and it's going to connect to your dishwasher and it's going to connect to your lights. I'm like, come on, get out of here. That's not, we all do that now. I can tell Alexa or whatever to turn. Oh, she's gonna probably talk to me now. You can just talk and things work, and most of the time your phone works with your headphone. But we take this for granted, and yet it was Star Trek just 15 years ago. And things like the cloud, being able to just watch whatever you want, whenever you want to watch. And AI, I don't know if you've had a chance to play with it or not, but ChatGPT is amazing for a lot of things, and it's been generative AI has been the thing over the last year or two. The ability to make videos and pictures and write resumes and other things, unbelievably interesting to do that. It's like a spreadsheet for words. The next wave that we're going to see in 2025 and beyond is what's called agentic AI, where you could talk to the AI bot and say, look, I'd really like to go to France for 2 weeks. These are the things I'm interested in doing. These are the things I'm interested in seeing. This is roughly what my budget looks like. And the thing will go away and come back with an itinerary and suggest, here's what you should do. And you can then tweak it, say, no, I'd like to spend more time in the museum, less time in the museum. And it will adjust it. And then it'll say, you can say, go book it. And it will book everything for you, all the airline tickets, hotel reservations, shows, and it's done. Like this is where it's going. And that's really important to be mindful of that because it's going to be really useful, but it's going to have a huge impact on so many service providers. So something I'm being mindful of is we talk about labor market. A lot of people's jobs in that structure are going to disappear or they're going to have to really change because the software is going to do things. And not much different than if you ever visit an Amazon warehouse. There used to be in warehouses, people driving forklifts around. A lot of people, no, there's almost nobody in there now. So industries change, and this isn't a better or worse, it just is. So I think AI, we're really trying to get our heads around how to allocate to this space because the ramifications are, I would argue, even bigger because it's manifesting all those other things on the screen together. So this is a huge thing. This is a huge thing.
Yeah, exactly that, Darren. And certainly, the companies that are using AI the best, we think are end up going to be winners. But those types of companies really haven't been identified yet, and there's a ton of startups that haven't come to market with product.
And
The other
and I'll
big
make a prediction right now, by the way, that there will be a company that will be one of the world's biggest companies in 8 years that hasn't been invented yet.
And the other thing, when we think about AI, it's not just those AI companies that are being affected. They're also affecting areas of the old economy. So utilities, materials, we talked about, the need for energy. Now we have a resurgence of nuclear. So materials such as uranium and uranium producers have come back into the fold, capital equipment providers. So really this is affecting a lot of areas of the economy. The winners and losers of it ultimately are not yet known because this technology is very early and disruptive. But when we look at getting exposure to this theme, the U.S. funds 3 times the nearest country, China, in new AI companies. And so that's just something to consider as well. We talked about the US before from a growth perspective, but in terms of productivity and development of new technology, they're leading in that area as well.
Yeah. And it's going
So
to
that's,
touch healthcare, which I know we're going to talk about as
yeah,
another trend.
healthcare we're going to finish up on. Before that, we're going to quickly just touch on, we talk about trade uncertainty. We talk about resurgence of Trump 2.0. One area we do have conviction is in the security of supply chains, reshoring, and to that end as well, an increase in defense spending. We can see in the first go around that NATO members increased significantly their defense spending under Trump 1.0. Many of them are still below the minimum requirement under NATO, and we think they'll be more than happy to eventually get back up to those requirements. So ultimately, the way that manifests in terms of defense spending as well as reshoring is through the industrial sector, which is actually showing the third best forward earnings revisions in 2025, and certainly could be a net beneficiary of these themes.
Mr. Trump is going to make everybody abide by their promises, it looks like. So,
So,
and here's the next one. This is the other big trend that we've already started doing a lot of work on in our portfolios.
yeah, over the last few months, we've done a ton of bottom up work on the healthcare sector. Really, over the past year, it's been very, very out of favor. Sentiment's been very poor. And a lot of that is actually from some one off events. We had the UNH executive that was killed in November. We had RFK being nominated, which added additional uncertainty. We had idiosyncratic risk from healthcare hacks earlier in the year. So the sector had a confluence of events throughout the year that really dragged it down. But right now it's trading at near an all-time low
Love a
relative to the
bargain.
S&P 500. And yeah, exactly that, Darren. We think it's a bargain. We've done a lot of work on this, and we think healthcare is really at the intersection of several secular trends. So we have globally populations aging at an increasing rate, and this has been correlated to an increased healthcare burden, need for medical devices. And so we own some medical device companies in our portfolios that have done very well. Aging populations itself have been estimated by the Conference Board to drive 20% of healthcare spend over the next 10 years. So we think that's a good tailwind at its back. Sector's also benefiting. We talked about AI, but AI deployment in areas such as drug discovery, diagnostics, healthcare administration. And we're seeing increasing advancements in medicine for treatment of widespread and rare diseases. And Darren touched upon weight loss as one of those. And then if we talk about relative earnings growth, they have accelerated earnings. So they have the second best earnings growth estimates in 2025, and they're trading as the most undervalued sector on a price to earnings over growth basis. So we like healthcare a lot. We've done a lot of work on the sector. And as a conclusion to our presentation, those are the 3 key areas that we just want to touch on to say, what, things may look expensive, but we are still finding opportunities. So it's not all gloomy.
Yeah, not everything is expensive, and there's always something to do. There's always something to do. So, Kristian, thank you very much. We kept it to under an hour, which was good. Thank you, by the way, for staying tuned. I think the ones going forward for the rest of the year will be a little shorter. The one we do at the beginning of the year, end of the year, is always the longest one because there's so much to capture. Kristian, thank you for putting all those charts and slides together. That's a huge amount of work to sift through the data and find what we think are the most interesting and important and insightful things to share. So thank you very much for that and for the work that you do on making sure our models and our pools are where we think they ought to be. And for clients and potential clients, thank you very much for watching. These kind of, they go in and they mark what we thought at a certain point in time, and we reserve the right to change our minds as the facts change. But we're doing our best to see through the fog. So with that, thank you very much for watching. Kristian, thank you very much too. Appreciate you.
Thanks, everyone.